This message comes from U.S. Bank. Expertise, encouragement, and support. That's what U.S. Bank is for. From incredible customer service to custom-fit personal loan options, U.S. Bank can help you achieve your goals. And the award-winning U.S. Bank mobile app puts your plan in your hand. Get started today at usbank.com. U.S. Bank, we'll get there together. Credit products are offered by U.S. Bank National Association and subject to normal credit approval. Equal housing lender, member FDIC.
Freedom is a feeling. Find out what true freedom feels like at Jeep Freedom Days. And now, well-qualified lessees get a low-mileage lease on the new two-row 2022 Grand Cherokee Laredo 4x4 for $359 a month for 24 months with $6,069 due at signing. Tax, title, license extra. No security deposit required. Call 1-888-925-JEEP for details. Requires dealer contribution only through U.S. Bank. Extra charge for miles over 20,000. Residency restrictions apply. Take delivery by 7/5/22. Jeep is a registered trademark.
You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face.
Hello and welcome to the China Shop. Come on inside. We're open up special store hours with the amazing team at Orderflow Labs. I'm shopkeeper Dan. With me is Kyle, creator of financialineptitude.com. Kyle, on a scale of 1 to completely drugged out of your mind, how excited are you today?
I am sober. I assure you, I am not high.
All right. Kyle's Marty McFly. I'm your bald high school principal, and we're proud to welcome Doc Brown. Fleri. Are you ready to get back to the futures?
Yeah, man. We're starting with a bang here, huh?
Yeah, always.
Always.
Yeah. So, any big news coming out of Orderflow Labs you'd like to share, Fleri?
Well, I mean, last time we talked, we launched our OFL suite of tools on MotiveWave. So just, kind of a reminder there that we are now live on MotiveWave, NinjaTrader, and Sierra Charts.
Nice.
And that's been going really well. We've got a lot of people coming in from MotiveWave. There's a lot of futures traders that kind of gravitate to that platform. Very intuitive, very easy to use, and you can use it with Mac or Apple products. I think that's been pretty cool, and some new studies coming out, and just some enhancements to some existing ones and some things like that. So kind of business as usual, and just excited to be able to continue to share and get people some of these tools. So appreciate you asking.
You just had a new one come out, didn't you?
Yeah, they just launched or just dropped the Joe Pivots Weekly, as well as just some enhancement automation type studies for extending ranges and some things like that, so that you can kind of connect a couple of your areas of interest and just kind of utilize some draw styles and things to just kind of make charting a little bit easier. But next week, or by the time this is airing, we're also making some of our other studies dynamic. So I know you like to use the Better Delta. That study will be dynamic so that it's just constantly update to the market's new volatility and ranges and stuff like that. So, just kind of continuing to enhance and make what we're already doing that much better, and bring in some new tools to the table as well.
You guys have also been doing a lot more content too. I think you guys have a blog that started up.
Yeah.
You've been doing a lot of live streams on Wednesdays.
Yeah, Leo's been putting some blog stuff together. I'm working on a blog post right now. I'm pretty excited about that. It'll come out here pretty soon. Kind of loosely calling it Averaging for Dummies, talking about how actually averaging to a losing trade, although I think it's sort of a double-edged sword, right? We average to trades, we do things that we probably shouldn't to trades, but we don't really understand the math behind how bad it is for us. Mm-hmm. And so it's kind of a data-driven blog post about how bad averaging is. So Averaging for Dummies, and just giving people a chance to sort of prepare for the inevitable bad decisions, versus I feel like we always prepare for good things to happen. What am I going to do when I'm in this great winning trade? Mm-hmm. Well, what do you do when you're starting to make bad decisions? So just kind of covering some of the math about that. But yeah, the blogs have been really cool. They'll continue to come out. Like you said, streaming, trying to stream every Wednesday. Summer months might be a little bit tougher, but trying to do the live stream thing on Wednesdays as well on our YouTube channel. So it's been really fun.
All right, make sure you guys check that out because there's a lot of great stuff coming up.
Yeah.
All right, should we move on to this month's discussion? And actually, we could start with Joel's question too, actually, because I think it's kind of applicable. What was the homework for episode 1?
That's a good question, considering we're here on episode 2. So I think last time we spoke, we left sort of the group and ourselves with the challenge to read Markets and Profile, or just some version of a market profile book. There's a few of them out there. Specifically, I talked about Markets and Profile from James Dalton. And then, the homework was to read that and just kind of have some general understandings of what market profile, auction market theory, and a TPO chart is. And then, this session, I think we're going to kind of discuss some of those broader topics, and hopefully in future episodes, kind of dive into maybe a little bit more of the nuance as well.
All right.
And then I think we also looked a little bit too at some of the Kelly criterion risk models for the accounts,
Right.
And that. I don't know if that's going to get covered this week, though, because I think Markets and Profiles probably got to cover most of it.
It's a lot to cover there.
I know, right? All right. Well, so one of the big things that the book kind of opens up with is talking about the difference between value and price. And I thought that was kind of an interesting perspective or take on it, because a lot of times we do focus on just the price of the underlying asset, but Markets and Profiles shows you a way to kind of figure out where the value is and how it's building that value. Like, where is the value at? How is that value moving? And then using that to inform your trading decisions.
Yeah, I think, even to kind of back up a little bit further than that, like in general, market profile or market profiling is, first of all, it's using a tool or a study called a TPO chart, or time price opportunity. And so in that TPO chart, essentially, the standard setting would be each profile is assigned a letter. So typically you'll see them with letters. Sometimes you see them with blocks, but A period, you'll hear people say that a lot, like A period, B period, or M period, which is the last period of the day. Each one of those periods gets sort of a letter in this profile that it's building. So the first 30 minutes would be A period, and then sequentially each 30 minutes after that is just a following letter. So you have like A period, B period, C period, so on and so forth, until you get to sort of the end of the cash session. And so that TPO chart, or the profile, as most call it, gets built throughout the day. There's some profile types, which we can talk about as well in the conversation. But, that's sort of the main tool, right? So we have this profile that's being built from the TPOs, or those time price opportunities. And then inside that profile, there's, to your point, there's some things that we can sort of glean. And the main one kind of being that value or value area. So typically on a profile, you'll have the value area that will either color the letters a different color, or potentially, just have lines extending from it as like a point of reference or something like that, depending on your platform. But that value basically is representing one standard deviation of where have we spent the most time. And so value is sort of another way to just say, like, what is the most fair, or what is the most traded price of the day? And so value area high obviously would be the edge of that, value area low. And then we have what's called the point of control, or the POC, which is that most traded price. And so the POC, in theory, is sort of like that fair value point, or, that's why they call it that point of control. And so, again, from an auction theory perspective, we have this way to sort of track where have market participants spent the most time. And then, from an auction theory perspective, those points where they've spent the most time, which, if you think about the way these profiles would build, if we have A period that's overlapped by B period, that's overlapped by C period, you'll start to get this sort of HVN, or high volume node, as it would sort of start to protrude out as these periods are overlapping. And so, we can start to see where market participants are spending the most amount of time. That kind of creates that fair value. And then, from that, we can start to glean some other things, such as like what what can we expect if we get above value? What kind of things should we look for from market participants? What kind of activity can we expect if we open at or near the previous day's value, and some of those things like that. But, kind of to circle back, the core of this market profiling or auction theory is sort of finding some trade ideas in and around that concept of fair value, which would, again, be where the market spent the most time during the session.
Right. Okay. So you mentioned the TPO chart itself, but it looks a lot to me like just a typical volume profile chart. And now when this guy came up with the TPO chart to begin with, the volume was not something that was easily accessible. They either had to estimate it or wait for the close to get that data.
Right.
So does it still make sense to use the TPO chart itself, or could you just get away with using like a daily profile?
Well, that's a heated argument, I would guess, depending on who you ask.
Didn't mean to start trying to get your beef.
So for me, I have the TPO chart up, and then I use Sierra charts, and right next to that TPO, it'll also print a volume profile, and I look at them side by side because just because we've spent the most time in an area doesn't mean we've built the most volume in an area. And there's certainly some things that you could learn from, looking at these things side by side. But for the most part, they're relatively interchangeable. The concepts are interchangeable. They both have value areas. They both have point of controls. They both basically develop what we would call high volume nodes or HVNs, and low volume nodes or LVNs, or some version of that, depending on whose literature you're reading. So, at the end of the day, does it make a massive difference? No. You could probably exchange one or the other. I think the thing with the TPO chart is the ability to sort of expand or, sort of stretch out that profile, and to be able to look at it in that 30-minute increment. So when you're bringing that time factor into it, whereas volume profiles typically are just looking at volume at price, or, I think Sierra calls it like a volume by price. So you don't have that element of time that's creating, a couple of different things, whether it's that HVN, LVN, single prints, or even one-time framing, which we've got a trend day up today for the most part, and there was some good one-time framing as well.
But you miss out on how the price moved from those areas.
Correct. Yeah. So you lose the element of time in a volume profile, but essentially you're going to see a lot of overlap. Like an HVN on a volume profile is typically going to be an HVN on a TPO chart. But the TPO is the tool that's used for the book that we were reading, but the concepts, I think, is the core of what it really wanted to kind of discuss, and some of those core concepts and how we can start to get an idea of how the market moves. And so, kind of to go back to the book, one of the big things about this market auction theory, and really why I wanted to share this as like a foundation, is, understanding how price moves in this auction. And, although it doesn't necessarily generally relate exactly to this TPO chart and a market profile, the concept of market auction theory is looking at, one, that fair value, but also like the way that price moves in and around the day. And so typically, and you probably read this in the book, markets are always going to go from a state of balance to imbalance and then back to balance. And so it's this kind of rotation back and forth between this journey. We just had, I think, an 8-day balance, and we broke out of that balance. And when we break out of balance, it typically looks like imbalance. And so you'll get trend days or these elongated profiles. As we break from balance, we go to imbalance. And that is representing basically leaving a place of fair pricing, right? Of balance is fair price or value. And then when we leave that price is no longer being accepted, and there's price discovery. So they have to kind of discover where the next place where balance will occur. And that discovery process looks like imbalance. And, you get days like today, which is a trend day up. And so, that movement between or from balance to imbalance and back to balance is sort of at the core of at least the way that I look and interpret the work around auction market theory. Finding that new point of fair value, whether it's a multi-day balance or just like an intraday profile, the same kind of concepts work whether you're looking at, say, a week, like we had that 8-day balance, or just today, which is sort of a trend type profile, and there's a balance near the top of it.
Mm-hmm.
And so, again, that journey from balance to imbalance, that search for the new fair value and the fair price. And then, kind of lastly, like, what does an auction process actually look like? And I think one of the key concepts of that is that auctions will always end in an excess. And this is a key concept also for market profiling. You'll hear about two versions of excess if you're reading, sort of any of the literature. And typically that excess is at the top or the bottom of a profile. And so I think, technically excess is probably just defined as like 2 ticks of excess to be a clean finish to an auction. And the idea there is that, in that process of trying to find let's just say it's an up auction, right? So we're auctioning upwards. As there's still buyers, willing to pay, say, 600, and then they're willing to pay 625, and they're willing to pay 650. The auction is sort of still going up. And so if buyers are still willing to buy at higher prices, why would sellers start to step in on that if buyers continue to push up? So, there's more demand and prices pushing up. Well, when you get to a certain point, the prices get to be sort of unfair, right? And, like today's version would be like right up at 11,666-ish or 670 in NQ. And we got to a point where there was no more buyers. And so then, that burst up and that last push creates that excess, and that sort of signifies the end of an auction. And when an auction ends, obviously then a new one can start. And so if we had an auction that started on the open today, which was Tuesday, 6/21, that auction started in A period and it sort of ended in C period. And so for three periods, or about an hour and a half, they auctioned upwards. They found the point where there was no more buyers interested. And if there's no more buyers, sellers now have to start to sort of come down and start to sell lower, because if they were able to sell higher and sell higher and sell higher, and now all of a sudden, there's no buyers. Well, what do you have to do to go find more buyers? You have to, push price lower.
Right.
And so, if you can't sell 11,670 anymore, well, now you got to sell, 650, and you got to sell 625. And, that shift in one auction starting and ending and a new auction starting, is something that's really key to being able to kind of understand what phase of the auction that you're in, and how you can start to sort of position against those things. The concept of one time framing is sort of in that same idea, and one time framing would be like each 30 minutes is progressing higher. So A period, high and low, then we go into B period, and B period holds the low and puts in a new high. We're one time framing higher. C period holds B period low and puts in a new high. We're one time framing higher. And so, again, we can start to glean some information about how the auction is progressing on multiple time frames, whether it's a low time frame or higher time frame. And so, again, I think understanding the way that a market actually works from a mechanics perspective is really key. And I do think that markets in profile, or market profile in general, does a good job of sort of visualizing that, because it's kind of a hard concept to read in a book. But when you see it on the profile, it becomes very clean and very clear. And today, there's really not that much excess. There might be 2 ticks. My profile is pretty condensed right now, but that high that's up there today, the C and D period is basically at the same price. And so, if we know an auction ends in excess, and we have price in C and D period that is at the same, that would be basically a weak high, or a poor high. And that is indicative that the auction is not done, and that there's more room to move higher. And so,
wait a minute, can you explain that a little more? So that's what a poor high is?
Yeah. So you basically, you have a poor high and you have a weak high. So the difference basically just being, so a week high is something that ends at an exact level. So let's say, the high of today is exactly the high of yesterday. That would be considered a week high.
Okay.
So, your market generated kind of information type levels. Today's low is exactly, yesterday's value area high or something like that. A poor high or low is an exact top, so a lack of excess. And so a poor high or low is indicative that the auction process is not complete. And so again, here I can actually, let me just expand the profile. I'll tell you if today is actually. And so the book defines that as 2 ticks of excess. It's really probably a discretionary thing. It's how you would decide that. But typically 2 ticks of excess is enough to complete an auction. And today's auction, today is a poor high. C and D period are basically the exact same high. And so, according to auction market theory, this auction to the upside has not been completed. And you can look at that from 2 ways. Either there's still more buying to do, so a poor high can be 2 things, right? We'll revisit this and potentially there's more buying to be done because the auction's not finished. Or you can also get a poor high from buyers sort of exhausting and they're not able to push through those levels. And, that's why typically you can see after a poor high or a poor low for that matter, the market will typically reverse for, at least some short period of time. And again, we'll usually revisit that spot. There's unfinished business at a poor or a poor high.
Interesting. That's the best explanation I think I've heard of it.
Yeah, that's a good one. That's a good one to look out for too. And again, building this idea of where could we go? One of the conversations I was having just before we jumped on was, everybody asking kind of well, where do we finish the day today? Well, we have a poor high. We could still go try to take that out. We're running out of time here a little bit in today's auction, but that's definitely a point that from a market profile perspective, you would keep that on your chart. So even if we open tomorrow and that poor high is still there, that's an area that we can expect to try to revisit sometime in the near future. And so they become sort of that market profile area of interest, those poor highs.
So it's almost like in order for an auction to complete, you almost need a few people getting really screwed.
Yeah, exactly.
Somebody's got to take home the artwork that's way overpriced.
Yep. Somebody bought the top, and typically that is that retail initiative push that blasts through a high, and then there's just nobody there, right? There's no follow through, and those guys get sort of left, holding the bag, if you will. Yeah, and so again, to kind of circle back, the idea of auction market theory is that process from completing it, starting an auction and completing it, and then starting another auction, whether that's a daily auction, a weekly auction, a 30-minute auction, which is what the profile would be showing, or even on the lower time frame. I think that's a key thing and why it's so important to understand this concept, because it's fractal all the way down, and really you'll see these patterns that we'll talk about here across multiple different time frames, whether it's a daily profile, whether it's a 512 tick chart on NQ. You're going to see this process of moving from balance to imbalance and back to balance, and that journey back and forth. And not only does the market move in that same ebb and flow, but it also moves from previous balance areas through a process of imbalance and typically to a new balance area that was at or near a previous one. And so I think from a fractal perspective, that's really key to understand. And I think you'll hear a lot of people talk about you want to have balance as a backstop. So, trade entry, as we pull into an area on a 512 tick chart that was a previous balance, they spent time there, whether it was 5 minute, 30 minutes, whatever. Price accepted this area. When we move away from that and form an imbalance, if we pull back into that area, you can now use that area as, sort of support and resistance. And on a profile, typically that would look like an HBN or something like that. And on a profile, imbalance typically looks like an LBN. So, again, this idea of an auction process and what that looks like, without going into kind of the nuance of, buying higher in supply and demand and things like that, essentially it's if we're going up and we're going up quickly, there's still buyers who are interested in pushing this price higher. And so if I'm willing to pay 5 and you're willing to pay 7, and I want to still get back in this market, now I have to pay 8, and if somebody will pay 9. And so that's what kind of creates these pushes that we'll see on trend days. And so this process of an auction starting and finishing is a key concept. We talked about fair value, so that's like time spent in that value area, which is showing you where one standard deviation of today's auction, or a multiple days auction, week, month auction, has spent their time. The next piece that he talks about that I think is also pretty key to understand is being able to kind of determine what type of market participants are in the market based on the way that the market is moving. And so, in the book, he kind of defines it as, I believe, like early adapters and laggards, or late adapters.
Innovators and...
Innovators is another one. Yeah. So that, the innovators, those are the ones that are kind of getting in there first, right? And typically those innovators are going to be people who are capable of putting in bottoms and tops. So not us, banks, hedge funds, institutions of some nature. And those leaders, those early adapters, they're typically taking, more risk because they're jumping into a market at an area where they're hoping to be able to obviously, turn it around if they're going to deploy a bunch of capital. And then, you have these laggards, or the late folks, which is typically like retail, that are trying to kind of ride this wave. And on a day like today, where the market is blasting through some of these very typical levels, such as like overnight high or yesterday's value area, like these MGI type levels that we all look at. Well, what kind of market participants don't care about where VWAP is, or don't care about where previous day's high is, or overnight high? Well, large market participants who are relatively price insensitive. And so, they want to keep buying. Today I'm buying. I have got orders to fill, so I'm buying. And I don't care if I'm buying here or if I'm buying, at half back, or, all of these sort of mechanical levels. And then in the inverse to that, you have what kind of market participants would be buying things like, half back of a period, or VWAP, or previous day's high, previous day's low. These sort of mechanical levels are typically trade locations for retail trades, or sort of small time frame traders. And so you have that concept of like, what kind of market participant does it take to start to move price, create these new distributions or these new balance areas. And, you have sort of the folks that are just kind of trying to come along for the ride. And typically those laggards are going to be what caused the excess, right? So if you were the momentum buyer and you're buying and the move already happened, and you're like, oh, look at me, I'm going to get in here too, we're going to break high of day. Well, the innovators, they're already in their positions. They're not going to help you push through this thing if they don't want to. And if they don't, you get stuck holding that bag. And that's where we get things like excess and things like that. So, there's also some of that concept there that I think that's important. And again, something that I would continue to kind of look into, of just understanding, the idea that there is early adapters or innovators, and then there's the laggards, or people that are late to the market, and how they can be responsible for both creating excess on lows and highs, depending on which way the auction's going.
He talked about two particular shapes, the P and B, when the TPO chart forms like a capital P or a lowercase b, is being indicative of intermediate term players stepping in. Is that what you're referring to, or is that how you're able to determine? Like, how do you know that that's long or a different time frame buying at that point? Is it because it's not at a specific price point and it's kind of spread out over like the range that P shape is forming? Is it just the volume that's showing up with it? Like, what is exactly?
So a handful of things. One, you never know, and really you don't need to. I think that from a day type perspective, or a profile shape perspective, there's some things that you can sort of infer from that. So, a P shaped profile, can happen on days where shorts are covering. And so, you get basically shorts who are like getting either blasted out, which is, what today kind of looks like. And you get sort of like that initiative push, And then once we push up into an area and we left sort of like an area that shorts were in, they're going to have to start to cover into this area. And that's where you get this like T-shaped type profile. The same thing on a B-shaped profile, but the opposite. As far as like being able to infer which type of market participants are there, I think one of the things that I would look for is, if larger players wanted to come in on a day where we open above the previous day's value area on a gap, which is what happened today, and we shoot out of the open, and we have, sort of excess in A period. You could probably argue whether some people will say A period or single prints or not, because it's the first period. But either way, right. We have singles, right? And we sort of are blasting through some of those big areas like previous day's highs or, overnight high, things like that. You can start to infer that, there's some larger market participants that are pushing this market up. And, as we continue to take out some of those key levels and, we keep pushing higher, push higher base, like that, those kind of things, you can kind of see that there's some bigger players at hand. Mm-hmm. If you were to like zoom out and look at, say, multiple days worth of a profile, especially like this week, if you went and looked even from like this week into last week, we started to migrate value higher, which is another concept of, sort of this auction theory is, what kind of market participants does it take in order to move price from, say, like a balance area at the lows, which were, we had a 2-day balance at the yearly lows. And then all of a sudden, value is migrating higher. And so, from value area high to value area low, I believe it was actually even fully gapped up higher. So, value is migrating higher multiple days in a row after a period of potentially, value sort of migrating lower. That's indicative that there's a change happening. And, us retail traders are typically not the kind of traders that are capable of moving value higher. Yeah, we went from, so on Thursday, 6/16, we had value that was, at basically the low of the year. And then the next day it was overlapping to higher and just barely overlapping. And then the holiday overlapping to higher. And now today it's gapped up and higher. And we opened above that 2-day balance on a gap, and value is, now again migrating higher. And so, there's some things there that you can also infer for what type of market participants does it take to be able to sort of move value, away from an area and create that imbalance. Because typically imbalance is going to be created when, a group of larger time frame or other time frame type traders no longer find that price that we were just at fair. And so they're going to go on a price exploration.
I also noticed when I'm looking at this profile charts too, the 3 days before the lows were put in, the balance area that was defined there to the balance area where the low was at was much smaller gap than the run up through that area. It wasn't quite overlapping, but you could see that the momentum was slowing down as this temporary bottom at least, was put in. Mm-hmm. And I think that was another one of the key concepts too. And it wasn't about like trying to look for, like the way he described his trading process was, it wasn't that he was looking for like, oh, this would be a great place to go long. It was more that, no, this is a terrible place to go short. There's too much risk here to be short. So now I'll look for longs because of that. And I thought that was kind of an interesting way of explaining his trading process.
Yeah, it's almost like a filter, the way that I kind of interpret it from him as well, of like a gauge for probabilities based upon, what is the profile? How is the profile sort of continuing to evolve? What state are we in? Are we in balance? Are we in imbalance? And what type of participants are theoretically in the market?
And I think again, some of it too is he was kind of putting themselves in the minds of both sides rather than just trying to think like, what do I want to do? Like,
right.
He took the time to think like, if I was selling right now, would I be very happy?
Well, and I think that's kind of the journey that we want, right? Like we want to surf. We want to ride those waves of the larger time frame or other time frame market participants, and the more that we can get that wind at our back, the easier time that we're going to have. And I think we all know what it feels like to try to fade a move like today,
Just
because we've all done it. Yeah. And,
Yeah.
I mean, it's that like those other time frame players, I mean, they're, like today, they're bid.exe. They're going. They don't care. They're just trying to get in, and they're going to pay whatever price they need to. They've either got orders to fill or a trade idea to complete. And, the difference between buying at 450 and 470 to them is sort of insignificant. And typically, too, it takes multiple days for these larger traders or these larger other time frame players to be able to build their positions. And so, that's why you get that sort of pattern of multiple days of balance. And then once they've kind of got that position and we're pushing, we can kind of leave an area. This price is no longer accepted anymore. Well, they're not going to accept it because they've got their position kind of going in there. And that, as we start to move away, somebody got it wrong. And I think, if we kind of leave the conversation of market auction theory with the fact that we have early adapters or innovators and we have laggards. The market's going to move from balance to imbalance. We have the concept of fair value and that point of control. We know that an auction needs to end in excess, and that auctions that have poor or weak highs are sort of incomplete. And then if we kind of take that into, now we get the idea of generally like, what does it take to move a market? What kind of participants move the market? What does it look like when they're done? What does it look like when they're building a position? Now we can start to look at the tool, the TPO itself, and start to glean some sort of trade ideas from that. And I think the best way I can just kind of describe it is, and there's multiple different ways to look at balance, but balance is God. Like it comes before it comes before all setups. Like a good God should come before anything. Balance is God for the way that markets move, and so. In my world, the way I look at some of my setups, if it's not in confluence to the way that the market is currently auctioning, it really needs to either be a super A+ setup, or I'm going to be on guard for this trade to only be, some version of an expectancy that it normally would, basically quick on the trigger if I'm fading sort of what the market profile or the concept of balance is telling me. And so, in order to do that, you kind of have to be able to define balance. And I think that's where a lot of people struggle with using market profile and really just in trading in general. And that's why, you've heard me say a bunch that I like to take me out of the equation as much as possible. If I'm looking at a bunch of TPOs and I'm trying to decide what a balance area is, is it a 3-day? Is it a 5-day balance? Does this day count? Does that day count? Is this imbalance? Like that's where I start to struggle. And so, I think one of the key things that I would suggest is, find out how you want to define balance. And, there's a handful of ways that you can do that, whether it's just, the days are overlapping or, some amount of price. What I do is I just do it strictly by value. And so if today's value is overlapping at all to yesterday's value, those 2 days are in balance. And so I'll box them. And so that's my simple way to take me out of the equation is basically balance for me is defined as overlapping value to the right. So, Thursday's value area overlaps Friday's value area, even if it's just by a tick. Those 2 days are now in balance. And, if I can define balance as overlapping value, then I can also define imbalance as non-overlapping value. And so, for me, I think, and that's sort of the first piece of define what balance and imbalance means to you or looks like to you, whether you're going to put discretion in there or have a hard, set of rules like I do, define balance. And we're talking strictly on a TPO perspective. You could also define balance from an event. I know there's like Paul Revere, great trader. He does balance based upon, basically like a high and a low from sort of an event, whether it's like COVID lows or something like that. And then he'll start stacking balance. And so let's say, the balance area from the COVID lows was like 117 points. Well, he might define that balance as 117 points, and then he just starts stacking them. So there's another way to do that. But again, it's sort of a subset of rules. from a TPO perspective, my suggestion would be, just find a way to define it. Again, I'm using overlapping value to the right, and then no overlapping value, it basically would be imbalance. And so once we can define balance, and we're kind of comfortable with looking at what a profile looks like, we know what value looks like on our TPO charts. Once we can define balance, we can start to look for different trade ideas and how the market moves from balance to imbalance. And I can't reiterate this enough, that the patterns around the way the market moves from balance to imbalance are so repeatable. And if you go back and you look at a chart, they happen over and over and over and over again. And that's why, I kind of jokingly say that balance is God, because it's just something that just continues to happen because it's in and rooted to the core of what market auction theory is. And that's why I believe it works so well, and why, so many people use it. So I think the $1 million question would be, well, okay, great. What are those? What are those patterns?
Exactly.
And so I define them as basically 3 core trade ideas. And so the first one would be what I call a destination trade. And so a destination trade, for example, on an intraday profile, would be something like value area low to value area high. Mm-hmm. And so if we are creating our value area for the day, and let's say it's like today, we're in the last period of the day, and buyers push up to value area high. If you go back to sort of some of the auction theory stuff, we would expect to see buyers above value area high be aggressive, because if we're above fair value and we're buying, that means we're leaving the price that we thought was fair, and we're now willing to pay higher. And so if we get above value area high and there's not aggressive buying, and sellers step in and push price back into value, a destination trade would be the concept that if we rejected value area high, we typically will go to value area low. And so that destination trade, whether it's a destination from an intraday profile from value area high to value area low, or a multi-day balance, is really just a key concept and a key trade. And that can even be broken down even further into intraday from multiple balances inside the day. So, we leave one HVN, we go through an LVN, and we go back to the other HVN. Well, if we reject that upper HVN, where are we going to go back to? Well, we're going to go back to the place that we were just at, that we were all happy with the price, right?
Right.
And so those destination trades, whether it's intraday, intra-session sort of, or across multiple days of balance, are a very key trade. And so, one of the cool things about market profile is you can make these composite profiles. So you can take 2 days and make it one big profile, and you can see what the fairest price or value area was over multiple days. And so these destination trade ideas are really key. Understanding that when we fail at one, sort of extreme, we can typically go to the other extreme. And you can kind of take that same idea from the inside out. If we're at the point of control or the most traded price, and we are leaving that, typically we'll leave that and then go to the other edge. And so if we're trading from the inside out, we're going to trade from point of control to say value area high or low. And if we're trading from the outside in, we're going to trade from value area high or low, sort of to the other side. And so there's a handful of different sort of versions of those destination trades, but the main one I would say would be, that journey from value area low to value area high, or sort of the inverse of that, or from HVN to HVN.
You brought up volume as being the key indicator of whether or not that high is going to get rejected. And I think I had been looking at volume completely wrong when I read the book, and I think we were talking about this before you started recording. I always looked at volume coming in at like a high as being, oh shit, sellers are interested now. Look at them all selling. They're going to overwhelm this and push it back down. Whereas that doesn't make much sense when you're thinking about it in terms of auction theory, because if price is going to be rejected, it means that nobody wants to do business up there.
Right.
So the more people that are buying at that top, that means that they're actually interested in it and they think it's a good price.
Yeah, and they're moving price away. That's exactly it. So they're willing to pay what they think is a premium, right? So like if you're willing to buy through high of day or value area high, and you think price is going to continue to move higher, like if we're trading at 11,600 and you think we're getting to 11,700, well, 600 is a good deal. 610 is still an okay deal. 620, and it gets to that point where the buying would typically slow. But if it doesn't, to your point, like that's the kind of activity you want to see when you're leaving an area of value or fair price. Is if we're breaking through value area high, we really want to see aggressive buying. And if you don't see that, that's kind of bad news, right?
Well, that's when you load up your fades.
And that's what's not supporting the trade. So, again, those destination trades, whether they're multiple day profiles, intraday profiles, or just like from, one HVN to the next HVN, are a key concept and something that I would certainly suggest watching the way that price can kind of rotate around those from a destination perspective, because they repeat over and over again. Value area high to value area low, value area low to value area high, from one HVN or the point of control to the next one through an LVN, and just sort of watching the way that price is either accepting in a new area or rejecting that new area, and some of the things that happen with that.
What about leaving one balance area to another balance area? Is that another thing that you look for? Is that trade number 2? Am I segueing for you?
It was a nice segue. That would sort of be a version of this destination trade. Actually took a nice short last night on what I would call like the cave, right? So if you get these two HVNs and then in between, like let's say price breaks out from an HVN or a value area, and it creates this sort of like LVN or imbalance, and then it accepts a price up higher and also builds more volume up there. So we have an HVN, we have a low volume node or a LVN, and then we have another HVN. Well, if price rejects that upper HVN, you have this big old cave, is kind of what I call it. It's like a volume cave. And we will typically trade, if we can reject that upper HVN, we will trade sort of through that cave back down to the lower HVN. And so that would be another version of a destination trade, really, is like trading through those caves. They don't always look as clear as a cave, but essentially that concept is going just back to trading from balance to imbalance and back to balance. And so we were at a balance at the lower HVN. We imbalanced up, we created a new HVN or a new balance. If we reject that, we go back down to the previous accepted fair price. And if they try to break back down into that lower balance and they reject that at the LVN, which is a trade you'll hear a lot of profilers take, like risking off this LVN. That's another thing, because now that nobody was interested in the prices in between. They were interested up at the top, they were interested down in the bottom, but they weren't interested in the middle.
Why?
And so when you come back to that area, I mean, you can expect two things: either a sharp rip through that zone, like a destination trade through that cave, or they just never even get through it. They defend that LVN. In this case, let's say we traded from the lower distribution to the higher distribution. Buyers, when we get to the edge of that upper distribution, they're going to try to defend that low volume node because they don't want price to go back to that lower distribution. They worked hard to create that imbalance and that node up top. And I don't want to steal too much of that intraday thunder, because I'd love to have Job come on, because he is just like the wizard of this concept from a volume perspective, as well as just looking at a TPO type profile, and the way that the volume profile or a TPO profile is showing you how inventory is sort of moving around and how they're redistributing inventory. And I think that would be a great segue potentially into a future 3. Episode or episode 3, to get Job to come in and really give us some nuances on these intraday profiles and also composite profiles and how the market is moving from these HVNs or balances to other ones, and what that looks like from an inventory perspective. So kind of tee that up a little bit, but
I think that's perfect. Put him on the calendar right now and just let him know. Let him know when he's supposed to show up.
All right, I'll make sure he brings the heat. Okay, so we have destination trades. The next one is going to be the breakout. So if we know that we have balance as overlapping value to the right, and we'll just assume that that's the way I define it. So I'll sort of talk about the patterns in that way. Yeah. If we have a multi-day balance, when we break out of balance, like you just mentioned before, and we break out of this balance area on on volume. Well, now we have the opportunity to take that breakout trade and anticipate the imbalance that's coming. And so if you have a defined balance area high and low, a breakout of balance is a great place to take a trade opportunity. Now, without getting into too much about like where would you define your risk and things like that, the general concept is go find or define or define a balance area, whether it's a multi-day balance area, whether it's an intraday balance area. I think the easiest way to do it is to look at like multiple days of a TPO profile, define balance, and then look at what happens when price breaks out of a balance area. I mean, you can just go back to our charts from last week and go look at the 8-day balance. And we had 2 weeks of balance where price stayed relatively in the same area for 2 weeks. And when we broke that balance area low, which got tested like 3 or 4 times in NQ, what happened? I mean, we're trading basically 1,000 points lower than that. And so, that breakout or breakdown trade would be sort of that second category of trade. And, again, multi-day balances are probably the easiest way to see those trades. But, you've got sort of that concept there. So you've got breakouts and breakdowns.
You mentioned a couple different times about the flexibility of TPO and the markets being fractal. What's the lowest time frame you would go when using a TPO chart? Like if I wanted to supersize my learning and try to expose myself to as many different of these scenarios, I should be able to decrease the time period of the TPO charts and then be able to watch it on a smaller time frame and see the same information, correct?
I mean, in theory, yes, I believe some of the platforms would allow you to do that. I would actually probably suggest the opposite, going the other way. That daily profile with 30 minutes as each period is kind of standard. And I think it's probably just a really good place to start and get your strategies built. When I'm talking about the fractalness of the market, it's that concept of what balance looks like sort of intraday. So like we spent 5 minutes and price sort of undulated around this area. And then we break out of that area. From like a classic price action perspective, it might look like a bull flag or a bear flag or something like that. Like that would be a version of balance on a fractal or lower time frame. And then when we break out of that, that's sort of the imbalance as we, wide bar out of an area and we have sort of that breakout.
Gotcha.
So from a fractal perspective, that's more what I'm talking about. Like if you were to look at a 5-minute chart and just sort of envision if you were to sandwich that together, and again, some of the platforms might actually let you make, a 5-minute profile where a period is 5 minutes or something like that. And you could do that, but you can kind of just see it looking at, a bar chart, whether it's, 512 tick or 5 minutes or whatever. It's the same general concept.
Better to just go back and look at history.
Right. But, going the other way works too. So like, a weekly profile, a monthly profile, the same sort of concept. You can have balance over several months. So if you're a long-term investor or, sort of a swing trader, you might be looking at daily profiles as your lowest time frame. But the concept of looking at value and balance over, from daily and sort of weekly and monthly, I think is a great place to start and makes a lot of sense. But
sorry, I don't mean to keep derailing you. Let you get through trade number 3.
So the third version of the trade, and this is sort of the last one, is the failed breakout or breakdown. And this can be one of the most powerful trades I think that the market kind of offers because it's also a destination type trade. And so one of my favorite patterns is we have a multiple day balance, 2 days or more, and we peak above that balance area high and we fail and we come back into balance. Well, that activates what will typically be a destination trade. And I call these multi-day destination trades because it usually takes 2 or more days and you will traverse from that balance area low to balance area high. And so, we just had that happen on Wednesday of last week. And so we poked above. We had a 2-day balance from Monday and Tuesday, the 13th and the 14th of June. We poked above and failed above the 2-day balance. We closed just above the balance area high, and the overnight auction got us back into balance. And we basically traversed all the way from that balance area high to the balance area low over the course of the next 2 days. That was, 400 something points of that 2-day balance. And so that's sort of a smaller version of that, just a 2-day balance. But, you can see the same thing happened in that 8-day balance from last week. They sort of tried to break balance area low of that. I think at the time it was maybe like a 6-day balance. They had a false breakdown or a breakdown attempt. And when that failed, we basically took like a 2-day journey back to the balance area high. And so those false or fake breakdown or breakdown attempts, and then a reclaim of that balance area activates that multi-day destination trade. And that's the one I think you really, really want to be aware of as well. As it's just because that one's the one that you can get really caught off sides. We break out of a balance, and then they go, nope, we're not doing this. And when they say nope, and that move was not supported, and you're still trying to take that momentum, and all of the momentum is not going that way anymore, and we're going to destination trade back to the other side, that's where you can kind of find yourself in trouble trying to fade those moves. I think it was here. Let's see, what day was that? Because I love listening to when I have the time, FT71's like morning little morning meetings. I wish he did NQ. we need an NQ 71 or something. But anyways, he was warning that on 6-7, if we break balance area low and reclaim that, don't be caught short. You don't want to be caught short. And they did exactly that. They A period opened right at balance area low. They traded below balance, rejected it instantly, reclaimed balance area low, and basically just ripped and closed at high of day. And over the course of the next 2 days, essentially traversed all the way back to what was balance area high. And so, again, that's just a trade that you really want to be aware of. So, again, to kind of recap, we're defining balance. I define that as overlapping value to the right, and then I box basically the highs and lows of those days. So whatever the lowest low is, whatever the highest high is, that's how I'm boxing a TPO chart. And I'll send you some pictures as well.
Okay. Yeah, we'll put those on the description too, so people can see.
Perfect. So, we've defined balance, and then we have sort of these 3 trades that we take in and out of balance, or that I watch for, that sort of overrule any of the other stuff that we might create levels around or trade theses around. And again, the idea here is we've defined balance, and we know the way that the auction moves around that balance from auction theory and these 3 trades. We're either going to destination trade from value area high to value area low, HVN to HVN. Basically from fair value to fair value. We're going to break out of a balance area, or we're going to break out of a value area, or we're going to false break out of those. And being aware of those 3 things, I think, is that like key core foundation that a good trader should be able to understand the way the market is sort of typically moving. And, again, it's because these patterns just repeat over and over and over and over again. And you see that the market, regardless of what Delta is saying, or regardless of what options flows are and all of that stuff, sure, like there's trade ideas in and of like a ton of different things that you can do. But at the end of the day, the market moves from balance to imbalance, and it's always in some version of, an auction process, looking for excess, looking for prices to be fair, and then those fair prices to be no longer deemed fair, moving to imbalance, and then trying to find those new fair prices. And so I think, again, that core concept of just really understanding that the ebb and flow of the way the market moves from balance to imbalance and how to read those TPO charts is just a great place to build a foundation and a good first filter to what trades can look like.
It's also, I think, would be really useful, even if you're not going to trade them, just to be aware of them. Because like you said, it should override. Like if I'm looking for a short, but one of your setups just happened and it's saying that, no, don't be short here, then I can at least disqualify a normal setup that I'd otherwise would have taken.
Right. That example from FT71's, morning
exactly.
show, where I think he straight up said, don't be short. You want to be long if we reclaim. If we break this balance area low and they reclaim it, you do not want to get caught off sides on this move. Like, that's a classic example of understanding the way that markets move around these balance areas. And that was, again, like a 6-day balance at the time. That's big. So these trades are going to be even more magnified. Being aware of how what stage the market's in of this version of moving from balance to imbalance is really important. Like, knowing that we were going to open right at balance area low was a very important thing to know. And so, again, being kind of aware of those things, and just, in general, the market auction theory is why I believe that this really is a good foundation starting point for people coming into the markets to really understand, like, how are these things moving around? And then, whether, to your point, like whether you're taking these trade ideas or not, just being aware of them so that you don't find yourself, I've got this short thesis and you're fading, a false breakdown of a 9-day balance or something like that.
Right.
And you're like, well, why didn't this work? It's like, well, zoom out and take a look. Because, it's just not going to work when this pattern repeats over and over and over and over.
So what kind of homework do we have for next month then, if we're going to prepare for Job? Is it Job or Job?
Job, like Book of Job.
Like the book. Yeah.
Yep, like the book. I think taking a deeper dive now that we've had this conversation around the auction theory and obviously the book, let's familiarize ourselves a little bit more with the TPO chart. Let's start to try to define what balance means to us. And again, happy to put some stuff up that we can post on how I define balance. But again, that's just overlapping value to the right, and whatever any days that overlap, those are balance areas. And then starting to look at the concept of sort of like, what does a balance look like intraday? So like in HVNs, LVNs, and I think that'll get us ready for sort of what will likely be sort of a masterclass in volume profiling, and those same concepts will make sense for the TPO as well. To have Job join us for episode 3 and kind of look at some of the nuances around what does a profile look like, and how can we start to glean some information from how they're moving inventory in and around the auction.
I like it. All right. So I have define balance, imbalance, observe price as it moves to and from, familiarize ourselves with the TPO charts, and then an observation, kind of figure out what balance looks like intraday.
Correct. Yep. Yeah. And I would even go as far as like, see if you can find a few of those examples from the 3 trade ideas. I'll post one of each as well that we can put up on the website or in the Discord, and just go back and just go look. I mean, it's crazy to go back and look like how often you see these same things happen. Like how important it is to understand the way that these markets move from balance to imbalance, and kind of hopefully have that aha moment of like, whoa, okay, there's a trend day as we left a balance area. Okay, I get it. Here's after we had a couple days of imbalance. Oh, look, here's a very balanced like profile. And so I think, again, define that balance, go back and take a look at that, and that'll kind of get us ready for some of the more nuanced things that Job can talk to us about like the way that these profiles are building and things like that. Potentially day types too. And again, maybe we can tee Job up to talk a little bit about some of the day types and how, based upon day types and the way that the inventory is being distributed, we can start to glean some things from, how is the rest of this day going to progress and some things like that. So essentially, we'll jump into some more advanced stuff on this same concept from a volume profile and a TPO perspective.
I like it. All right, we ready to answer some questions then?
Yeah, let's do it.
All right. We gave one from Joel that was a silly one, but how about we give him a real one? He wants to know that for the people that are struggling to get through and understand the book that was recommended initially, if there was any other resources or ways to learn that auction theory. I think you shared some with him, but I think it's good for anybody else listening.
I still remember reading that the first time and like having to pause and be like, what in the name of Jesus is this guy talking about? And I had to go to YouTube, and I think my aha moment for finally understanding this whole concept of market profile was like I got about a third-ish of the way through the book and was like, okay, I have no idea what this guy's talking about. I paused and I went and watched some of his videos on YouTube, which he has a bunch, and a handful of just like other people who are really good at seeing it, because I think visualizing the market profile is so much easier than trying to read it in relatively old book.
And part of the problem too is trying to flip between the chart and what he's saying. Like they're on different pages, and you're like, okay, what the fuck? Does that
and he's got like the open, high, low, close bars and stuff like. It's just like okay, so pause. Go check out some YouTube content on like basics of market profile. And I think that's like a really good place, because then you'll go, oh, okay, now it's making sense. Like I remember reading about like excess, and then you go and you're like, you look at a video and this guy's pointing out like a very clear M period excess. Like it's just going to make a little bit more sense. So that's what I would do. I would pause. There's tons of great content on YouTube, and you probably just search like market profile basics and you'll have that sort of light bulb moment.
I think you had some you shared on our Discord. I'll put links to that in the description as well.
Cool.
Purdue wanted to know, and I think you already mentioned one aha moment, but he wanted to know what your aha moment learning to trade was. Was that it? When markets and profile finally clicked in your head?
It was definitely one. It was like one of the early ones of like understanding that I'm starting to build a foundation. And I think that's why I wanted to kind of bring this into this conversation of like, it was my aha moment from like, I can build something on just this basic concept of knowing that markets move from balance to imbalance. More bigger picture, like I think the reality of my aha moment was really diving into the math of trading and the stats, and sort of understanding that, after I built this foundation and after I sort of built some trade ideas, and I had areas where I wanted to do business, and I knew how I wanted to execute, and I knew what my brackets and my risk and all that looked like. And then I had stats. And then I put those stats into some of those things we talked about in the first episode, like the equity curves and understanding bet sizing and Kelly criterion, and like how much I should be risking, and that was kind of like the big aha moment of. And I think you're kind of going through that right now, right? Like you've been going through some of this exercise, and you're actually getting some of these stats from taking a bunch of very disciplined trades off of your ideas. And you're now able to plug those in and go, whoa, like this, if I do just this and I manage these stats and I keep a track of like what's working, what's not working, or just change nothing and just kind of be on guard, there's sort of a solution to it. I hate to say that, but I mean, the stats are the stats. Like if you create a process that's repeatable and then you manage those stats and you control your risk, it's really just sort of a law of large numbers sort of after that, and then just managing what you're doing. Like the process won't always work exactly the same, and there's different, vol regimes and things that will change, bear markets, bull markets, whatever. But at the end of the day, once you understand the math behind your process, and then what is the feedback loop from those stats, that's like that aha moment, because that really is what gave me the confidence to continue to execute every time I saw one of my setups.
Yes. Yeah, I would 100% agree with that. I think the biggest thing for me, though, was figuring out that I needed to define my setups like a computer program. So that way there was no thinking or interpretation on my part. Like I tried to take myself out of the equation as much as I possibly could, to the point where now I should be able to hand a sheet of paper to my wife and say, hey, every time this happens, click the button.
Take these trades, right? Yeah. And I think, that's, is that probably where you'll trade in, a few years? No, maybe not. But it's a great place to build and get that foundation and build that confidence. And I think that's the key, is like usually scared to click that button, whether you're scared because you don't think your trade's as good as it should be, or you don't want to put the risk on. Like all of those things are sort of subject to some version of a math problem. And hate to boil it all down to a math problem, but when you do all this complex work and then you get a math problem solved, and that your ideas are generating alpha, over and over again, then you can, just go to the market and try to find your ideas. And
if there's any science I want behind my trading plan, I want it to be math.
There you go. I like it. So yeah, that would be my aha moment is like seeing the math after building a process and then understanding how to test my process and know that it's a winning process, or at least, slightly winning or break even, or even bad, and I need to work on the process. Once I was able to define through math whether or not what I was doing was going to work in the long run, that was sort of that aha moment.
Awesome. Last question then we have from Bear Goes Long. He would like to know which tools or indicators we can use to determine a day type pre-market and as the auction is progressing.
A day type. Yeah, so this is probably one of the most asked questions around market profile. And I'll touch on it briefly. I think Joe will probably hit on some of this from like the way a profile builds.
Uh-huh.
But essentially, from a TPO perspective, I think the core things you want to look at is where you're opening. And so you're either going to open sort of in value, and when I say in value, that's to yesterday's value, in value and in range, or out of value and out of range, or some combination of that. So you could open above yesterday's value, but inside of yesterday's price. And that's a great place to start as far as like starting to get an idea of what kind of market participants might be behind a move if we see this on the open. And today would be a great example of that. So it's Tuesday, 6/21, and we opened out of value and out of range. And we saw aggressive buying right on the open. And we got essentially a version of a trend day up. Now, it ended up being sort of a P-shaped profile, and we didn't quite get that second push. But still, a really nice trade opportunity off the open based upon understanding sort of where you're opening. And I think that's probably the key to like the pre-market of those simple check. Are we opening in yesterday's range or out of yesterday's range? Are we opening in yesterday's value and out of yesterday's value? So obviously, if we open out of those ranges and values, we can expect volatility and potentially imbalance. So we're sort of leaning one way or the other. They're either going to, they're going to reject this open and go try to fill a gap, and that's sort of like where those gap rules come in, or we're going to accept this move away from yesterday's value and range or balance area high, and we're going to aggress higher or lower. And so that kind of goes back to like, what would you expect to see? If we're opening above value and above range and we see aggressive buying, well, let's get on board. And I think the other thing that I would look at outside of TPO, we talked about this a bunch of, are we holding RTH VWAP? Are we holding RTH mid? I think is a huge tool to use to glean whether or not we're going to continue moving higher. Because everybody kind of wants to know, like, is today going to be a trend day? Well, did we open above value and above range? And did we hold RTH VWAP and mid on the open? Did we hold opening range low? Whether it's a 30-second, 1 minute, there's a bunch of these little things that you can look at. As far as intraday, that's like a really cool, fun, nuanced thing with profiling that you can really start to sort of like get an idea on. And, today would be an interesting version of that as well, because we sort of had that A, B, and C period breakout where, hey, this could be a trend day. Well, then they just sort of started creating this bigger upper HVN and this P-shaped profile. Well, the market now closed and they never broke out of that poor high. But had they broken out of that poor high, we might have seen a double distribution day where now we get like, say, single prints and say D or E period, and then they, create an upper distribution. And so I think understanding how, or sort of like doing these like if then statements on what the profile looks like currently, and if we break out above the current high and we single print, what would that look like? So like knowing that we still have an opportunity for double distribution, what does that look like? If we don't create this double distribution and, we sort of reject value area high, what would that look like? And you can kind of start to get some ideas around what a day type can progress into. And I think that's sort of an advanced concept, but also something that is worth kind of always being aware of, right? Like if we were sort of one time framing A, B, and C period, and then we're basing a little bit in D period, we're still one time framing higher, and then boom, they break out and we get single prints through the highs, and we start to then build volume up through those single prints. Well, now, we had an initiative move. We based, and then we had another initiative move, and now we're accepting or building volume higher. Each move is sort of progressing higher and being accepted higher. And, you kind of want to be able to be ready for those sort of opportunities. And, maybe on a day like today, that looks something like still just holding on to a runner until, one time framing ends, or still holding on to a runner until, they break the low of value area, or something like that, and still giving the day an opportunity to evolve into something that, maybe completes a bigger trade thesis or some of those things.
Is there any coincidence that today is ending right in the middle of the previous balance that, at least on the ES, the balance from the 10th to the 15th?
No, that's not a coincidence at all, because we've just moved from balance to imbalance and right back to balance.
Accepted balance.
Yep. And so when we leave an area that we accepted and we imbalance, I think one thing that the market does a lot is it just goes to a place it knows, right? And so if we're leaving this price and there was a price that was previously accepted just above us, well, we got to at least go check that out, right? Because we came from lower, we imbalanced higher. Well, now we're kind of where we left before, so it was the point of previous imbalance. I actually call those island days, which we can, again, I'll put some examples out there, but that's just a typical place where you see the market go back to. We leave balance, we go to imbalance, and typically that new balance is usually overlapping some other previously accepted price, or that point where we left balance from before. And, it's sort of that circle of life of that journey between balance, imbalance, and back to balance. So, no, not shocked at all to find out that ES is basically right back in an island day.
I appreciate how the balance area lines up with the volume profile so nicely.
I know, right?
Yeah, because you typically, if you're volume profiling, these multi-day balances are going to be like weekly HVNs, monthly HVNs. Yep. And so I think you'll see a lot of confluence between some of that higher time frame work. I see a lot of confluence between my sort of like swing highs and swing lows trend analysis from like the 4-hour and daily, weekly charts. Because again, you're finding those points where there was a shift in inventory, where there was a shift from an accepted price. And there's a handful of different ways to visualize that. And, I think the TPO just offers like a very obviously visual way to do that using the profile. So
excellent.
All right. Did we get through everything? I think we covered everything.
That was a pretty good crash course. And I'm by no means a market profile expert. So
that's okay. We got the expert coming next time.
Feel free to roast me in the comments on my version of it. But at the end of the day, I think the key is it's a core concept. Find a way to, put some structure around how you would use it. It's a useful tool. Again, for me, it's that overlapping value, and then, a few patterns that just are really repeatable in it. And if you choose to dive into some of the more nuanced things with, single prints and one-time framing and market participants and, some of the things that you can start to do, then more power to you. But I think just having a general idea of the way that these things work and defining it for you is just a great core foundation before you start diving into some more advanced work later on.
I like it. Dan, we got anything else we need to hit before we wrap this up?
No, I think we have a very good base for TPO charts. This has been really good.
Yes, I think there'll be a lot of happy people in the Discord.
I'm a happy person.
Yeah, I'm happy. I'm just sad they have to wait a week to hear it.
I kept rereading the first half of the book, thinking it would just click, and I wish I just read the whole thing over and over again, not kept rereading chapters trying to get them to click.
Just skip to chapter 6.
Yeah, listen to this first and then read the book.
Yeah,
there you go. That might be easier.
That might be way easier.
Yeah. Anyway, all right. Thank you again, Fleri. This is, as always, you are a wizard of the charts and explanation. You do such a wonderful job. I want to thank you again for coming by.
A doctor?
I would issue you a PhD. Now, if you could help me with some time travel so I can go back to the 80s and invest in Apple.
God, we'll work on that next. That's episode 5.
Yeah, episode 5.
All Why did Biff go with sports? Why didn't anybody go and...
Yeah, just long IBM.
Well, no, if you go bet like the World Series outsized bets, especially in the 80s, you're probably going to piss off some mobsters.
Yeah.
Whereas in the stock market, like, you're fine. Like, just...
They'd probably get you for insider trading. They're like, we don't know how you're doing it.
Yeah.
You're not losing, so you're out. Anyway.
Well, you can make some losses just to... all right. Well, this is going to get out of control.
You got to be smart about it. All right. We're clearly writing a film, and we got to do that off air. Thank you again, Fleri. This has been fantastic.
You're welcome, guys.
All right. If anybody wants to submit questions for next month's topic, they can join our Discord, or they can just direct message them to us. They can email us at twobulls@financialineptitude.com, or if you're part of the Orderflow Labs, you can just send a direct message to one of the admin members there, preferably somebody who's actually been on the show so they know what is going on.
What the heck we're talking about.
Yeah, right.
So, Fleri or Leo are probably your best bets.
Spam, delete.
Yeah, right. Why is this guy asking me questions about profile?
I love it.
Thanks for sticking around, folks. We'll be back at you next month. We'll be back to the futures. But until then, happy trades.
This message comes from U.S. Bank. Expertise, encouragement, and support. That's what U.S. Bank is for. From incredible customer service to custom-fit personal loan options, U.S. Bank can help you achieve your goals. And the award-winning U.S. Bank mobile app puts your plan in your hand. Get started today at usbank.com. U.S. Bank, we'll get there together. Credit products are offered by U.S. Bank National Association and subject to normal credit approval. Equal housing lender, member FDIC.
Freedom is a feeling. Find out what true freedom feels like at Jeep Freedom Days. And now, well-qualified lessees get a low-mileage lease on the new two-row 2022 Grand Cherokee Laredo 4x4 for $359 a month for 24 months with $6,069 due at signing. Tax, title, license extra. No security deposit required. Call 1-888-925-JEEP for details. Requires dealer contribution only through U.S. Bank. Extra charge for miles over 20,000. Residency restrictions apply. Take delivery by 7/5/22. Jeep is a registered trademark.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks in the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.